Hello and welcome. Today, we're diving into a topic that can be a real minefield in Canadian tax: the rules for associated companies. Now, if you're a business owner or a tax advisor, you know that getting this right is absolutely critical. It can be the difference between significant tax savings and a very unwelcome surprise from the CRA. So, we're going to break it all down, step by step, with practical examples.
Well, hello there. I'm Gemini.
So, here's our game plan. We'll start with the why. Why do these rules even exist? And it all comes back to a huge tax incentive. Then, we'll roll up our sleeves and walk through 4 different scenarios, seeing exactly how these rules apply in the real world.
Okay, let's jump right in. Before we can even begin to understand the nuts and bolts of the association rules, we have to grasp their purpose. And the whole reason they exist comes down to one thing: protecting the integrity of the small business deduction, or the SBD.
So what is the SBD? Well, think of it as a very generous tax break for small businesses in Canada. It gives them a much lower tax rate on their first $500,000 of active business income each year. But here's the key phrase: annual business limit. That limit is meant to be claimed once per business, not over and over again.
And right here, this is the exact loophole the government wanted to close. You can see how easy it would be, right? If your company makes $1 million, why not just create a second company, split the income, and claim the SBD twice? Without the association rules, that's exactly what everyone would do. These rules are the fence built to prevent that from happening.
Okay, so now that we know the why, let's dive into the how. How does the government actually stop this multiplication of the SBD? Well, the solution is found in the Income Tax Act itself.
The main event is Section 256 of the Act. This section lays out 5 very specific tests for when companies are considered associated. But before we get into those, we have to introduce a key character in this story: the concept of related persons. This idea, defined in Section 251, is fundamental. It basically refers to people connected by blood, marriage, common law partnership, or adoption. You'll see this concept pop up again and again.
All right, time to get our hands dirty. Let's apply these rules to our first case study. This one is a classic example that involves control by related people, plus an interesting little twist. Okay, let's look at the players. We have 2 companies, A and B. John has a controlling stake in Company A with 60%. His father, meanwhile, controls Company B with a whopping 80%. And here's the important detail: John's father also owns 25% of Company A. Albert, their friend, is just a minority shareholder in both.
So here's the big question: are these 2 companies associated? I mean, on the surface, it seems obvious, right? John controls one, his father controls the other. They're clearly related persons. Seems like a slam dunk. But hold on. In tax law, it's rarely that simple. There's another condition we have to check.
And this is where the details really matter. Let's unpack this rule from paragraph C. It's actually a 2-part test. First, you need 2 companies, each controlled by a person, and those 2 people have to be related. We've got that with John and his father. But there's a second piece. One of those 2 people has to own at least 25% of the shares in both companies.
And there you have it. Let's check the boxes. Is John's father related to John? Yes. Does he own at least 25% of Company B? Yes, he owns 80%. And does he own at least 25% of Company A? Yes, he owns exactly 25%. Because he satisfies that cross-ownership test, both conditions of the rule are met. Boom! The companies are associated.
Okay, let's switch gears. Our next scenario introduces a completely different way for companies to be linked, and it has nothing to do with family relationships. This is all about control by a group of persons.
The setup is a little different this time. John still has 60% of Company A, but now we have George, his cousin, who owns 50% of Company B. And here's a fun tax fact for you. Under the Income Tax Act, cousins are generally not considered related persons. But look at their combined ownership across both companies. It's significant.
So, if they aren't technically related, does that mean the companies are in the clear? Not so fast. The key question now becomes: do John and George, acting together, form a group that controls both of these businesses? Let's look at the numbers. Together, they own 70% of A and 55% of B.
This brings us to paragraph B, and this rule casts a much wider net. It's not looking for family ties. It asks a much broader question. Are both corporations controlled by the exact same person, or by the exact same group of persons?
And that's exactly what's happening here. When you add their shares together, John and George have more than 50% of Company A. They have 70%. And they have more than 50% of Company B. They have 55%. They have formed a control group. And since that same group controls both companies, the companies are associated.
Now, this next scenario is probably the most direct and intuitive one we'll look at today. This is the classic parent-subsidiary relationship.
The structure here is super clean. John owns 100% of Company A, which we'll call the parent company. And then Company A, the parent, turns around and owns 80% of Company B, the subsidiary. It's a very straightforward chain of ownership.
The rule for this situation, paragraph A, is refreshingly simple. If one corporation controls the other, they are associated. That's it. Control is generally defined as owning more than 50% of the voting shares. End of story.
So this one is really a no-brainer. Company A owns 80% of Company B, which is well over that 50% threshold for control. Therefore, under the simplest rule of all, paragraph A, these two companies are absolutely associated.
All right, for a final scenario, we're going to ramp up the complexity just a little bit. This is where we see how control can be layered, and you really have to trace the ownership through different entities to see the full picture. Okay, let's break this down carefully. To figure out John's total control of Company C, we can't just look at the 20% he owns directly. We have to account for his indirect control that flows through Company A. He owns 80% of Company A, and Company A owns 40% of Company C, so we multiply those together. 80% of 40% gives him 32% of indirect control.
Then, the final step is to add his indirect control of 32% to his direct ownership of 20%, and that brings his total effective control of Company C to 52%. Since that's over the 50% mark, he officially has control.
So let's put all the pieces of this puzzle together. What we've created here is a web of association. We know A controls B, so they're associated. And we just proved that John controls both A and C, so they're associated. And because they are all connected through John, all three companies, A, B, and C, get tangled together. In the real world, this means they all have to share one single small business deduction.
And that brings our formal discussion to a close. We've really focused today on what tax professionals call de jure control. That's control by the numbers, based on who owns the shares. But this opens up a much bigger and frankly much murkier question. What about de facto control? This is control in fact, maybe through economic dependency or other agreements, even without owning a majority of shares. That's a whole other can of worms for another day. But it's a fantastic reminder that in tax, you always have to look beyond just the surface.